This is Macro Voices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Macro Voices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was so great to have Francesco back on the show. And it's funny because going back to 2018 in January, we had both Chris Cole and Francesco on the show just prior to the Volmageddon event. And it's interesting that we have the same lineup of guests right before this market event. Nonetheless, it was really interesting to see him talking about the complexity-based system risks. Whether you take a George Soros reflexivity or something, it's really important to understand how dynamic the market is. And it's really interesting to get his take on all of that.
Well, I guess we have a new market indicator that is proven now to be 100% effective, which is when we have both Chris Cole and Francesco Filia scheduled in the same month, it means there's going to be a big vol event in the market. I'm glad to put that into my playbook. Let's move on, though, because our listeners gave us terrific feedback. Last week, you did part one of long volatility trades using options, and we intentionally started last week by not getting into tail hedges, but just focusing on volatility itself, how to buy volatility using the options market. This week, I know our listeners want to learn about the tail hedge aspect of it. Patrick, you put together a post-game chart book, which our listeners can find in the Research Roundup email. If you don't have a Research Roundup email, that means you're not registered. Shame on you. Just go to macrovoices.com, look for the red button that says Looking for the Downloads next to Francesco's picture. Patrick, let's talk about this chart book. I see you don't have Kevin Muir in his Market Huddle menswear on the first page. I would recommend adding that since he lost a bet with you recently. But let's go ahead and dive into the rest of the chart book.
Well, for sure. And so it's actually amazing that the market had this event right in between the two presentations, because the one thing we were really emphasizing last week was that when you go long volatility, it's great for that one rainy day event, but it's not necessarily the great strategy for a rainy decade, the way Chris Cole put it. The whole point is anyone who went long volatility, whether you did a strategy to go long Vega or you went long the VIX in any way, you got a pretty good payoff with the volatility having spiked now up to the 30+% range. But really at this moment, you got this big payoff for this big spike. But being long volatility at these like 30+% vol levels is not asymmetric anymore. And you can now just as easily get hurt as you can continue to make more money. And so the idea behind being long volatility for this kind of bigger portfolio hedge is this idea of going long tail risk, which is when the market makes these extraordinary moves out of these tight ranges, that you're making money on the wings, both on the up and the downside of these big market moves. And so the question is, how can you do this with a very little or small carry cost? And that's really the interesting part that we want to dive into this. And so what it really comes down to, in order to be long tail risk, you need an option strategy that is long gamma on the wings. It's this idea where the option will really start to behave like a full-on equity position when one of those wings is reached on the markets. And so what I wanted to do on page 3 is just start off by explaining delta and gamma, terms that many of our listeners may have heard us use before, but just it's important to kind of give a framework for understanding the theory behind it. So it's important before we talk gamma to understand delta. And so delta is the Greek that measures the rate of change of the price of the option, the rate of change of the option itself, relative to the change of the underlying price. So the easiest way to think about it, Eric, is if, let's say, a stock rises from, let's say, $10 to $11, and the option that you own increased by 50 cents, then you can more or less assume, if all other variables were constant, that the delta was 50 cents. Right, which is that it's about the sensitivity of the option for a change in the underlying price. But gamma, on the other hand, is the second derivative of that. Gamma measures the rate of change of the delta itself. And so this is where I think that the easiest way to think about it is on page 4 by explaining it by showing this chart, which is what we have is the slope of a call option there. And an option's journey is whether it's journey down to a delta 0 or up to a delta 1. And where it is on the slope of this curve is the delta of the option. And what the gamma is the rate of which this slope is steepening or flattening. And so this is an example of how we want to look at gamma from that chart.
Okay, Patrick, I got the concepts. Gamma is the second derivative, the rate of change of delta. Got the Greek concepts down, but okay, wait a minute. How do I turn this into a strategy that achieves the kind of portfolio goals that Chris Cole was talking about?
Right. And so this is where I just need one last major point to be very clear to our listeners. And then we'll talk about the idea of putting this into a strategy. The whole point that you can see on page 5 is that when you're long gamma, when you're long options, whether you're long a call or you're long a put, you're long gamma or have a positive gamma. And the problem with buying a call or buying a put is it costs money. And it suffers from theta or time decay. And so when you hear the term that it has a negative carry is the fact that when you put on these options, they're time decaying while you own them, right? And so the question or the key way of trying to find how to put a strategy together is how can you build a strategy that doesn't have that huge negative carry, or at least changes the composition of where the negative outcome of the trade is negative. And so this is where I want to kind of talk about the only way you can really offset the fact that you're suffering time decay and it costs you money to carry this is to somehow combine short options with long options in order to create an offset for that negative carry. And so on page 6, what we have is just a traditional long put chart graph. And what this is just showing is the fact that, well, when you spend money to buy a put to, let's say, insure a portfolio and you want to buy some tail risk to insure the downside risk of that zone below the red line is the zone where you have that negative carry, which is essentially that no matter how high the stock goes, the cost of the option is a loss, and that loss is reducing your performance. And so how do you create a chart or some sort of a strategy that doesn't have that negative carry, that where even you're able to have that tail risk insurance, this idea that if, let's say, the market was to crash, that you're going to be able to cash in. But at the same time, if the market just keeps muddling along, it doesn't cost you a whole bunch of money to have these put options.
Okay, so if I want to buy insurance, I have to pay an insurance premium for that insurance. The way to offset that is to sell somebody else insurance, and the trick to it is to sell somebody insurance that's insurance that doesn't cost me very much to sell them, because what I'm insuring them against is something I'm not too worried about losing. Is that the gist of it?
Sort of. I mean, definitely you're trying to create the offset. Now, we've had numerous conversations in past shows. I mean, you even had the conversation with Tian Yang from Variant Perception, and then we talked about the strategy in many post games about using the ratio call spread, which is the way you would buy right tail insurance or the participation on a big right tail move in the stock market. But for this example, I wanted to just illustrate a left tail ratioed put spread because that's one we haven't talked about. Now, the key here is that I just calculated theoretical prices based on a constant volatility. And so what we have is a $100 stock. And what we do here is we sell short the at the money $100 strike put. And so for selling a put, before we buy any options would be considered naked, you receive a $2.85 credit in this theoretical example. And so when we receive $285 income, we proceed to go out of the money. Let's say in this example, we're using the $95 put strike, and we buy twice as many puts down at the $95 strike. Those $95 strike puts, so remember we're short the 100. Here, we're going to buy twice as many 95s. Those were trading 97 cents at least from the numbers we put into the simulator. And therefore, it costs us $1.94 or $194 to buy these two puts. But because we received the credit, we are actually still left with a 91-cent credit after buying those two puts. What this creates is a scenario that is so long as the market continues to stay flat or continues to rise, we are actually ahead of the game with a credit. We're actually earning an income. And often you can build these at zero cost, even if it has a small debit. The point is that if the market is rallying, it's costing you nothing to have this ratio put spread open. So where's the risk? That sounds almost too good to be true, right? Well, the risk is that one scenario where the market goes down a little and it is going against you a bit. And there you have a situation, as you can see on this chart, where the greatest risk in this ratio put spread is at $95. But there's that old adage, Eric, which is that the markets rise on an escalator but drop on an elevator. Rarely do we see scenarios where the market goes down just a little bit. And when one of these market corrections kicks in, it usually is a very violent drop, as we saw over the last 5 days, which is it blows right through that risk point and then catches that left tail, which is that you start making a pile of money when it drops below 90 in this example. And so what you're trying to do is create a scenario where a month after month or a year after year, while the markets are behaving, it's costing you very little to carry this hedge. But then when the market finally has an event, then you have something that builds huge intrinsic value when the market really starts to go against you. And so the ratio spread is one of the ways that you could do this with a very little carry.
So the graph on page 7 illustrates this visually, but going back to my insurance analogy, what you're really saying here is you want to buy insurance. If the market crashes, you want to get paid off big time with a great big insurance settlement. Problem is you'd have to pay a premium for that insurance. So what you do is you sell somebody else insurance against the market going down just a little bit, because you know that's not a very likely scenario. But that actually pays pretty well. So you end up collecting the premium that someone else is paying you for insurance on something you don't think is going to happen, and you end up paying for your own insurance policy and still having cash left over, which you pocket as a profit unless the market goes down just a little bit. Speaking of which, Patrick, I got more than just a little bit of email last week when I mentioned in passing that maybe you should put on one of your famous boot camps, this time on trading volatility, taking this beyond the level of what we're able to do here in the postgame segments on Macro Voices. I know from my email inbox there's a lot of interest. So what's going on? You got a plan now?
Yeah, so far we've been talking about this long vol and these tail risk hedging strategies in these theoretical scenarios. But however, in the live markets, it's far more dynamic with things like the vol skew influencing the option pricing. For instance, there's not always, but often a very fat left tail, which changes the way you can put this trade on. So understanding the vol surface of an options market is so important. And so it's important for me to be able to demonstrate to my members anyway, the impact and how to manage trades in these environments. So I'll be demonstrating these volatility strategies real time in the live markets, and I'll be doing that in that live volatility bootcamp. So we scheduled it for Friday, March 6th at 10 a.m. for Big Picture Trading members.
Okay, so for anyone who wants to watch you put on these long vol trades in a live session where they can actually watch you put the trades on in your online broker screen, that's 10 a.m. Eastern Time on March 6th. And that, of course, is for Big Picture Trading members only, but you can get a free trial membership to Big Picture Trading. Patrick, in addition to this boot camp, what else can people expect from Big Picture Trading membership?
So, Eric, the membership allows you to basically trade along with me. All Big Picture Trading members receive access to all my analytics and trades, most of which I do in daily live webinars where members can interact and trade along with me as I put on these trades and help members manage that risk.
Okay, and that is for paid members, so that's not for free.
Right. There is a 14-day trial offer, which is still open and anyone can get access to. But to attend that live vol trading bootcamp, it's only for our paying members. And that membership is $99 a month. That includes not only that upcoming Volatility live bootcamp, but it also includes some of the other strategies we covered in theory on Macro Voices, such as those ratio call spreads and the calendared straddles, which again, we just used to catch another market top. And so all of these boot camps and other tutorials are all available in the membership. More detailed information on Big Picture Trading membership can be found in that chart book.
Okay, fantastic. So how do people sign up?
They can sign up by just clicking on that sign up button on the last page of the chart book, or you can also find the link in the Research Roundup email, or you can visit the bigpicturetrading.com website or email us.
This episode was made possible by TopTradersUnplugged.com. Remember to get the ultimate guide to the best investing books ever written at TopTradersUnplugged.com/macro guide. For information on sponsoring Macro Voices, please visit macrovoices.com/sponsor info. Listeners, be sure to register a free account at macrovoices.com. The benefit to you is you'll receive our Research Roundup email, which provides you with all of the best free content that we could find on the internet each week, including downloads associated with our guest appearances, as well as, of course, our post-game chart books. Patrick, tell them what they missed in this week's Research Roundup.
This week, you're going to find a transcript for today's interview, as well as a link to the chart book for Francesco's presentation, as well as the charts we just discussed here in the postgame. There's an article from Jeff Snyder, That's the Thing About Things, and the video link to Centelli Exchange talking about the negative feedback loop. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. If you have not already, follow our main Twitter account at Macro Voices for all the most recent updates and releases. You can also follow Eric on Twitter at Eric S. Townsend and myself at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.